we'll get started. So I know both of you, but hi, I'm Megan Moore with the Legislative Services Division, and today's Lunch and Learn is on individual income tax and some structural changes, as well as some possible developments at the federal level that might affect Montana's income taxes. I'm going to turn it over to Sam to introduce himself, and then I'm going to share my screen.
Hello, I'm Sam Schaefer with the Legislative Fiscal Division. I primarily deal with revenue, more specifically individual and corporate income taxes. And then I do some other work in other areas like pension analysis and revenue risk.
Yeah, and I forgot to add, I'm a research analyst with the Legislative Services Division and staff for the House Taxation Committee and the Revenue Interim Committee. So let's get the slides up on the screen. Okay. So there have been a number of individual income tax changes in Montana since about 2021. And I summarized the bills here on this first slide just in case you wish to refer back to them. And these slides will be posted after the presentation, so you can click on the links within them. So the first bill is Senate Bill 159 from 2021, which reduced the top marginal tax rate for individual income taxes. The biggest bill in content was Senate Bill 399 from 2021, and this included structural changes to the individual income tax mostly, as well as rate revisions and repeal of a number of deductions and credits. And most of the changes in that bill did not go into effect until tax year 2024, but some of them went into effect before that, and we'll talk about that as we go. The next bill is House Bill 221 from 2023, and this revised tax rates for net long-term capital gains. Also in 2023 was Senate Bill 121, which reduced the top marginal tax rate and increased the earned income tax credit. And then finally in 2023 is Senate Bill 550, which made some clarifying changes to Senate Bill 399 and extended the medical savings accounts that had been repealed in Senate Bill 399. So I'm going to talk about some structural changes before 2024 and after 2024. So before 2024, the individual income tax linked to federal adjusted gross income, and we had Montana-specific standard or itemized deductions as well as personal exemptions. Now, once Senate Bill 399 was implemented in 2024 tax year, we now link to federal taxable income, and we use the federal standard or itemized deductions, and we no longer have personal exemptions because there are currently none at the federal level. Another change in from before 2024 to after is to the tax rate schedule. Before 2024, there was a single tax rate schedule. So if you were married or single head of household, you had the same rates that applied to the same levels of income. Now, after 2024, we have different tax rate schedules for single taxpayers, married filing jointly or married filing singly, and head of household. And what this means is that taxpayers who used to, especially married taxpayers, used to file individually, or excuse me, they used to file jointly at the federal level, and then they would have to split their income to file in Montana in order to take advantage of the lower tax rates because there was only a single rate schedule. And now that is not possible because in the past you could use a different state and federal filing status, but under Senate Bill 399, you have to use the same federal filing status. So if you file married at the federal level, you also file married at the state level. This slide just brings home the point about the difference between federal taxable income and federal adjusted gross income. So if you can This is a federal 1040 form from 2023. And you can see that I've circled on line 11 adjusted gross income. And before 2024, that's the number you would have started your Montana tax return with. Now you start with the number on line 15, the federal taxable income. And as you can see, that line 12, the standard deduction or itemized deduction, is subtracted out from the adjusted gross income. So that's why I say that we are incorporating the federal standard deduction or itemized deduction, and this will come up more later in the presentation. A couple of other notes about deductions and credits and how they differ before and after the structural changes. Before 2024, we had deductions for unemployment, tips, workers' compensation, and interest income for people 65 and older, as well as some pension and IRA exclusions. After 2024, most of these deductions are repealed. However, there is an age 65 plus subtraction of $5,500, which I believe is intended to make up for those lost interest income and pension IRA deductions. There's also a partial military retiree income exemption that went into effect with Senate Bill 104. And then finally, many tax credits were repealed at the end of 2022 through Senate Bill 399. This slide just summarizes the tax rates in recent history. Before 2022, we had 7 different tax brackets. So that's different income levels with different tax rates associated with them, with the top rate being 6.9%. In 2022, the rate, we still had 7 brackets, but the rate dropped to 6.75%. And then in 2024, after the implementation of Senate Bill 399 and another bill in 2023, I believe it was Senate Bill 121, we went to just 2 brackets, so only 2 income levels with a top rate of 5.9%. This slide summarizes some of the same types of changes for the corporate income tax and for businesses. And we're not going to talk about most of these in detail, except Sam is going to talk about the last one. But those changes in 2021 and in 2023 were bills to revise the way corporate income is apportioned for corporate income tax purposes. There is different factors that are used to determine income, and in 2021 there was a change to double weight the sales factor, and then in 2023 to move to a single sales factor apportionment, which follows the policy of many other states. There's also a bill in 2023, Senate Bill 246, to eliminate the inclusion of tax havens for water's edge election. This is a policy that allows a corporation to pay a slightly higher tax rate and only include their income in their business that is in the US, the water's edge of the US. And then Sam's going to talk about Senate Bill 554 in a bit here, and that provided for an optional pass-through entity tax. And now Sam's going to present for a bit.
Thank you, Megan. Just for context, this pie chart shows the fiscal year 2024, which ended, June 30th of calendar 2024, ongoing general revenues for the state of Montana. General revenues we define as those sources of, taxes and fees that are deposited into the general fund, as well as the state levied 95 mills, which now go to a state special revenue fund. And there's also interest earnings that are earned on Treasury cash that for fiscal 23, 24, and 25 are deposited into a state special revenue fund to pay down state debt and liabilities. So this pie chart includes all the general fund revenue sources, as well as the state levied 95 mills for property taxes and those interest earnings. You can see that we are an income tax state. Individual income tax in fiscal 24 was about $2.24 billion. That was 57% of all of our general revenues. And then at about 9 o'clock on this pie chart, you can also see that corporate income tax made an additional 8% of total general revenues, and it came in at about $312 million in fiscal 24. This pie chart shows what we call our top 7 general revenue sources. So that's income tax, property, corporate, vehicle, insurance, video gaming, and oil and natural gas taxes. And then you can see there's remaining sources that make up about 13% of the remaining general revenues. And that's composed of nearly, I'd say, close to 30 different small taxes and fees. Next slide, Megan. So, like I said, we are an income tax state. That is true now more than it was in the past. This chart shows those general revenues again that we just showed you in the pie chart, but it shows them historically back to fiscal year 2002. As you can see on this chart, we have 3 bars. We have individual income tax in the light yellow, corporate income tax is sort of that beige, dark beige color, and then all those other remaining sources. So not just the remaining from the previous slide, but that would also include things like property taxes and vehicle taxes and gaming taxes in the blue here. Back in fiscal 2002, if you look at the top of that bar chart, you can see that our income taxes, that's corporate and individual combined, made up about 46% of total general revenues. As recently as fiscal 2024, you can see on the far right-hand side, it is now nearly 2/3 of total general revenues. And if you just go back to fiscal 2022, that was a very strong year for individual income taxes. And in that year, our income taxes, both individual and corporate combined, actually surpassed 70%. So as time progresses, we've seen a larger reliance on our income taxes, and the next few slides will sort of illustrate why that, I don't want to say can pose problems, but we always illustrate this to the legislature when we meet with finance committees or tax committees. So next slide. So income taxes are quite volatile. And what we mean by that is even under quote unquote normal economic conditions, you can see very, very wild swings in the growth rate of these two sources from one year to the next. And then when there are maybe booms in the economy or small recessions, the impact is really magnified in these two sources. There's 2 lines here that show year-over-year growth rates. You can see corporate income tax in green, which is actually more volatile than individual income tax, can have year-over-year growth changes, as you can see on this chart, that nearly approach 60%, and then in some years can have declines, below 40%. While not as volatile as corporate income tax, individual income tax can also be extremely volatile. And one thing that volatility does is it can bring unexpected surpluses and or shortfalls into the budget picture due to this tendency to change and due to the difficulty with forecasting these sources. Obviously, in fiscal 21 and 22, both these sources saw extremely strong growth. You can see those growth rates there for those two years can be in excess of 40%. But in recent years, we've seen them essentially decline in their growth rates. And in fiscal 2024, essentially both of them had flat growth. That's why you can see both lines converging to that 0% growth in fiscal 2024. Next slide. So that is in contrast to some other revenue sources we have. The scale on the left-hand side is the same as the previous graph. It goes from negative 60% annual change to positive 80% annual change. And you can see sources such as video gaming tax, and that's sort of the yellow, and vehicle taxes and fees in the darker line. These are also top 7 sources, but you can see from one year to the next, they have a fairly predictable pattern. They are much easier to forecast on a year-to-year basis, and they're not as subject to as wild of swings as you can see with our income taxes, though every now and then you can see sort of deviations from the long-term trend. Next slide. And as Megan said earlier, this is a brief synopsis on how Senate Bill 554, which was passed in the 2023 legislature, works. A little bit of backstory. The federal tax bill, the TCJA that was passed, did put a limitation on essentially state and local tax deductions that you could deduct from your taxes. The cap was $10,000. What Senate Bill 554 did is it provided for an optional pass-through entity tax. And when we're talking about pass-through entities, we're talking about S corporations, LLCs, and other pass-through businesses. What Senate Bill 554 did is it allowed pass-through businesses to classify state tax liabilities as an above-the-line business expense. So if there was a if there was a state tax liability as a result of pass-through income, instead of counting towards that itemized deduction of $10,000, it instead is classified as a business expense. So it does not count towards that itemized deduction capped for state taxes of $10,000. So really what this does is it provided an avenue for taxpayers to lower their federal tax liability, whereas at the state level in the long term, we expect this mostly to be revenue neutral. The reason that we expect that is, as I said, the pass-through entity pays the tax on the income associated with the pass-through. So it's not the individual taxpayer. So the way this works is the pass-through pays the tax, but then the individual still has to claim that income on their return when they file individual income taxes for Montana. So in addition to other income they may have, they do have to include that pass-through income. But since the tax was already paid, the taxpayer is then issued a credit against that liability. This brings some timing and sort of sporadic collections into individual income tax here, because what we've realized is that people and taxpayers may not always claim the credit right away. So what we see right now is that there were a lot of pass-throughs at the end of last calendar year that made payments to reduce their liabilities, but there's still a material number of credits that are still outstanding that we expect to either show up in the form of refunds or reduce liabilities in the future. Like we said, this was passed very recently, so we're still trying to get a handle on how this will impact collections from one fiscal year to the next. Like I said earlier, for the state, it is expected to be revenue neutral in the long term, meaning year A and year B may see an increase in one year and a decrease in the next, but more or less it will wash over the course of a few years. But that doesn't mean we could get unexpected increases or declines in any one year. Next slide, Megan.
Okay, this one is back to me. And this is a good segue into a little more discussion about the Tax Cuts and Jobs Act that Sam referenced. This was a bill passed at the US level, the federal level, in 2017. And it included changes to the individual and corporate income tax. And some of those changes are permanent and some are going to expire at the end of 2025. And because Montana now links to federal taxable income, any changes or expiration of these provisions could affect the Montana income tax. And I'm going to go through how those might affect the Montana income tax in a moment. But another thing to keep in mind about this is, depending when a change or any legislation on this passed, it could be the end of 2025, which is when the legislature is not in session. So it's just something to keep in mind as you work through this session. And on this next slide, I show some of the provisions that may affect the Montana income tax. And the first is the standard deduction, which I mentioned at the beginning, and that's why I showed you the difference between federal taxable and federal adjusted gross income. When the Tax Cuts and Jobs Act was first passed in 2017 and we linked to Montana adjusted gross income, the changes at that time didn't affect us because we had our own standard deduction and itemized deductions. But now that we are linked to federal taxable income, changes to the standard deduction would affect the income tax collections in Montana. So the schedule change is that this would return to the pre-2017 amount, which is half of the current standard deduction. Another change would be to itemize deductions, which include the $10,000 limit on state and local taxes that Sam mentioned, and also the mortgage interest limit, which is currently $750,000, meaning you can't deduct your mortgage interest if your mortgage is higher than $750,000. That would revert back to $1 million. And the other thing that would come back is the personal exemptions, which is just over $4,000 per family member. There's also a provision on bonus depreciation that under current law phases down in the following way. It's 40% in 2025, it would go to 20% in 2026 and 0% in 2027. However, changes to the Tax Cuts and Jobs Act extension could affect this. And bonus depreciation is a provision that allows a business to depreciate an asset, which means they pay lower taxes on it earlier in its life. And a couple of other things to keep in mind in this regard is the discussions at the federal level about federal tax policy. President-elect Trump has suggested that he's interested in exempting Social Security and tip income from taxation. And if those provisions did go into effect, they would also affect Montana's income tax collections. So with that, we can take any questions.